I'm joined here today by Bill Spence from Schiller Spence and Associates. Thanks so much for joining me, Bill, and taking the time to talk to me today.
Appreciate it, Marcus. Thanks for reaching out.
We've recently reached our highest inflation rate since 1983. In your simplest terms, what did it take for us to get here?
Yeah, it's been an interesting last couple of years. Sometimes people forget that the inflation rate has been fairly stable over the last 10 years. In our planning and working with clients, we've used 2%, even though it was about 1.8% over the last couple of years. But through COVID and some loose monetary policy, governments got money out into the public, into businesses, which was required to get us through COVID. But this is the consequence of that. And now we're starting to see inflation rates, at the end of last year, near 5%, and then late into summer here around 7%. So a fallout of COVID, the support that we got from the government, this is where we're at.
How do high inflation rates affect our communities and the people living in them?
Yeah, and so I mean, for you and myself and our friends and our neighbors, where we're seeing it is at the gas pump, right? It's every time you go to fuel up, it seems like the price has gone up. Despite what my wife says at the grocery store, because I don't buy groceries, but grocery prices have gone through the roof as well. So I mean, for the average Canadian out there, gas prices, groceries. You're going to see that over the course of the winter. You would have seen it in your direct energy bills as well, energy bills, natural gas and such. And so that's where you're going to notice that. I think the biggest thing through that, as I mentioned earlier, inflation rate has been fairly stable. We've seen a spike. The long-term projection is that we will get this under control. So it's important to look at your budget, your living expenses. How are you able to handle that? If you're on a fixed income or on a retirement basis, have you had an opportunity to sit with your financial advisor to go through that and see what that impact is on your plan, your retirement plan, and what are the consequences moving forward? And do you need to make any necessary changes to that? So really important to sit down with your advisor to go through those different things and the impact it will have on you.
What can people kind of do to endure this time period of high inflation?
Well, so high inflation. So there's a couple of things. One, from an investment side of it, you want to stay invested. As inflation rates rose, the bank is now countered by increasing interest rates, right? So that's the way they're try to bring that down. So that does have some negative implications as people that do have any loans out there. The biggest one for most of us is our mortgage. And so as mortgages are coming due, renewal, maybe you're consolidating debt. Sitting down with an advisor and looking at the difference between a fixed rate and a variable rate. What does that mean? What is the definitions of that? What is the benefit of each? Because they both have benefits. Variable rates are going to have some fluctuation over time. As prime lending goes up, variable rates are going to go up. If you're into a fixed one, you're going to have that same level payment over in a typical 5-year term. So is it more beneficial for me to have that fixed payment, knowing what I'm going to be paying over the next 5 years versus the volatility of a variable rate? Yes, there's a differential, but at what point does it get higher than a fixed rate that you could lend into? And as I mentioned earlier, the spike is temporary, so it's going to start to come down as inflation rates go down. Inflation rates, interest rates will also reduce. So then there's a reduction in years 3, 4, 5 of interest rates. So again, sitting down with somebody, going through it, what is the right fit for you? So that's on the lending side. From the investment side, we talk to our clients, and it's not about timing the market. With the volatility that we've seen in the equity markets over the last 6 months, clients naturally want to pull back from markets investments because they see a loss on paper. And probably one of the worst things you can do is liquidate or move to cash any investments you have, because now you're solidifying those losses, but also you're reducing the opportunity to recap any of those gains that you may have lost over the last 6 months. And knock on wood, the last week has been good in the market, so hopefully the trend is going to move forward. So inside your investments, stay invested. Let your portfolio managers work behind the scenes to take advantage of the upswing. And second is activate any cash. Obviously, if you have cash that you're sitting on that you need short term, keep it as cash. Or if you have a large purchase coming up, look at what the options are for you to activate that. But when inflation rate is at 5, 6, 7%, and you're sitting on cash, you're essentially losing money on that. And so if you have money, get it actively invested so that you can take advantage of it over a longer period of time.
Unfortunately, that's all the time we have. Bill, thank you so much for joining me. It was really great hearing from you.
Yeah, thanks, Marcus. Again, I wish all your viewers a great long weekend. And if anybody has questions, they're more than welcome to reach out for some one-on-one time with us.